Welcome to episode 5 of Talking About Change. This episode is entitled The Global Financial Crisis of 2007 2008. Change is constant and ever present in our lives, but we don't often ponder what change is generally in a way that might apply across all domains of our experience and activity. That is what this series is intended to do, to help you build a framework for reflecting on and analyzing change as it plays out in all aspects of our lives and our world. One of the most significant changes to impact our lives in recent memory was the financial crisis of 2007 2008. This episode will focus on that catastrophic change in our global financial system. It was a real body blow to our economy. Generally, a financial crisis occurs when there is a dramatic drop in the price of an asset or set of assets, assets whose value are vitally important to our economy. For the financial crisis of 2007 2008, the assets that plummeted in value and were so key to the United States economy were houses. When an asset becomes overinflated in price, then precipitously drops in price, that represents the bursting of an asset bubble. Essentially, the financial crisis of 2007 2008 was due to the bursting of the housing bubble in the US. Building up to the crisis, the bubble formed. Coming close to the threshold of crisis, the bubble continued to expand, but at an accelerating pace. And when uncontrolled expansion reached a critical point, the bubble burst, leaving in its wake a recession of global proportions. A number of conditions set up the circumstances for the formation of the bubble. Low interest rates allowed for easy money. Lax lending standards of banks allowed home buyers to purchase homes that they could not really afford. Insufficient regulation of financial institutions, banks, investment firms, insurance companies, ratings agencies, allowed for reckless and speculative financial transactions. In the face of stagnant wages in recent economic history, houses were one of the last sectors of the economy available for the middle class to build significant wealth. People flocked to purchase homes. And with home prices seemingly rising forever, more and more people purchased homes, often taking advantage of subprime loans that would allow them to purchase more home than they could really afford. Politicians fueled this asset inflation by speaking of the virtues of home ownership and ensuring policies that would allow for that broad-based home ownership. Heavy advertising on radio and TV added to this exuberance, touting subprime loans and home investments that could make you rich quickly. With these conditions in place, the bubble could form and was set for uncontrolled expansion. With a lot of money sloshing around globally and low interest rates prevailing, investors were looking for places to park their money and get good returns on it. The U.S. housing market, booming in value as it was, attracted a lot of this capital, and money flowed into the market, inflating the bubble. Bankers would take their mortgages and, working with financial institutions, bundle the mortgages together, slice and dice these bundles, and trade them in a secondary market of financial instruments called collateralized debt obligations, or CDOs. To feed this market, lenders were pressured to issue more and more loans. And global investors were more than eager to participate in this hot market. The ratings agencies, given how the mortgages were bundled and with the actual value behind the instruments, now obfuscated by the slicing and dicing of the mortgages making them up, gave the instruments solid ratings, suggesting that they were not unduly risky. Insurance agencies played a role in reducing perceived risk too by insuring financial institutions against defaults on these loans. What investor, awash with cash to invest, could resist a market that was rising in value and apparently had manageable risk? So, with homeowners snatching up more and more homes, bigger and bigger and more pricey, with brokers and lenders encouraged to qualify these folks for loans, with bankers making money off the sale of the mortgage bundles and reducing risk in the process, with financial institutions hungry for these instruments, with ratings agencies and insurance companies covering up and managing the risk of these investments, and with investors more than ready to jump into this hot market, with all these players in the market, we saw the housing market and the secondary market of mortgage-backed securities expanding and expanding and expanding until the asset bubble burst. The first sign of trouble was raised when housing prices started to fall in some real estate markets regionally. This set in motion the catastrophe to unfold. The broader economy was starting to stall at this time, and especially for those who lost jobs and had reduced incomes, they could no longer afford to keep up on their loan payments. Some mortgages, especially those that were subprime, had adjustable rates. People with such mortgages were especially hard hit when rates on their mortgages were reset. Many now were faced with payments that they could not make, and they defaulted on their loans. Global players in the financial system, seeing the signs of instability and increased risk in the subprime market in the US, were spooked by these rumblings in the market. Soon, panic started to set in, and the anxiety spread from one financial institution to another, causing ripples through the global financial system, building to a tsunami. The housing bubble had burst, generating the need for massive interventions by governments to restabilize their economies, precipitating a deep and long-lasting global recession, and leaving thousands in the US without homes, in dire financial straits, and with a significant portion of their wealth erased. The interacting complex of circumstances, actions, and forms that constitute any change were also at play here with the global financial crisis. We see that there were the circumstances of easy money and lax lending. We saw the actions of homeowners, lenders, bankers, financiers, regulators, and investors driving up the markets. And we saw the form it took of a broken financial system, frozen at one time to the point that no loans to consumers or even between banks were made. And then we saw an ensuing recession, requiring enormous government bailouts and stimulus to recover. Now, as with any change, the financial crisis was driven by the reworking of key connections. The reworking could be the making, breaking, or remaking of the connections constituting the factors underlying the change. With the global financial crisis, the first connection broken in the lead up to the crisis and central to creating the conditions for the housing bubble was that between a banker providing a home loan and the recipient of the loan. Now, when I was a kid, the local banker knew virtually everyone in the community. When my dad came to him for a home loan, this banker knew my dad and the details of his financial situation and was willing to take the risk of extending a loan to him, knowing he had the ability to repay the loan. They had a bond of trust between them that was merited. If my dad had run into any trouble repaying the loan, this banker, a member of the local community and a friend to my dad, would be able to work out a solution with him. Now, let's fast forward to the early noughts. Here, connections are broken. The loaner does not know the loan recipient well. The banker is now part of a much larger impersonal commercial bank, and that bank is no longer backing that loan directly, but packaging it with other mortgages to create securities that can be passed on to investment banks and other financial institutions. Investors, ratings agencies, and insurance companies are taking positions and risks with these securities that are not really connected with a full and accurate understanding of their value. The guardrails that should have been in place weren't there to structure and regulate the market to prevent unchecked and reckless speculation. And this started with the division that had been made between commercial and investment banking, removed during the 1990s. Consequent to the removal of that division between commercial and investment banking, commercial and investment banking were now connected in ways that they really should not have been. Adding to this heightening of risk were the close connections existing among financial institutions internationally, allowing for the contagion of panic globally. All of this led to a terrible end state for homeowners. Connections were broken between what you owe on your house and the value of the house, leaving you underwater. That is, owing more on your home than the market value of the home. We can now see that the connections among players in the financial system were broken, creating the conditions and allowing for the risky actions that precipitated the housing crisis. At the same time, the global scale of connections among investors and key institutions could serve to amplify and spread the collapse once it started, with a crack leading to a break in the proverbial dam, then with an ensuing flood of debt as that dam broke. The reworking of connections, along with the complex of circumstances, actions, and forms interacting to drive the dynamics of this reworking, illuminate essential aspects of any change in our lives and our world, and illustrate another way that a general framework can be applied to understand diverse change processes. If you found this episode provided insight into analyzing the change leading to the global financial crisis of 2007-2008, and you'd like to support me in developing more content related to discussing change more generally in all its forms, head over to my page on patreon.com. It's patreon.com/talkingaboutchange, all lowercase and strung together, patreon.com/talkingaboutchange, and become a patron. Thank you, and all